Alex Jershevsky, CEO of Recovery Partners, and we hope to have with us in a few minutes from New York, Christian Freeland, Global Editor-at-Large at Thomson Reuters. First to you, Bob, in Boston. What do you think? The 7 that failed were probably ones people thought were going to fail. Is this now in Vancouver? What's your read on what we know so far, Alex?
Well, Howard, this is really your Johnny Cochran moment here. The entire purpose of this exercise was PR. It was designed by the regulator and the governments in the EU to restore confidence in the euro, in the stability of banks there. They weren't going to chance anything. They set the process up so that we get the kind of result we saw today. We've got some people picking over the bones and quibbling about some numbers, but at the end of the day, what the authorities were aiming for is what they presented us with today. As soon as these results started coming out, you got prepared statements from Wolfgang Schäuble and a few of the other governments, Schäuble being the finance minister in Germany, saying that, it's wonderful that German banks passed the test. Well, big deal. This is a process that we now have an outcome for that was designed to appear as though things are stable. So we've got this outcome. To quibble about some numbers, if you look inside some of the stress tests, they're really once over lightly. The loss.
That's not what the Bank of Italy said. The Bank of Italy says these were rigorous and severe tests.
Well, of course, that's what they'd like to have everybody believe. But at the end of the day, it's a once over lightly. The loss given default scenarios on the sovereign tests were extremely light. I believe the loss given default they were assuming for the Greek bonds was only 23%. With a significant move in CDS spreads, you can get that on an overnight move. A loss of 20% on a long-dated bond. So at the end of the day, I think the authorities got what they're aiming for here. Let's see what the market's verdict is going to be over the next several weeks.
Okay, let's go. Go ahead. Go ahead.
Well, that's exactly the issue. Can they raise capital? Will they raise capital? In the case of Ireland, most of the banks are nationalized. In the case of Spain, you've got a bunch of walking wounded. Sure, they do have to raise capital. I think the acid test will be what the verdict of the markets is going to be over the next several weeks. In Canada, we didn't have any stress tests a year ago. We're not having them now. But at the same time, the banks were strongly encouraged to shore up their capital bases by the regulator and the authorities here. They did do so without the benefit of any PR exercise as a tailwind. In the U.S., additionally, last year when they ran the PR, they ran the stress tests. We had a share price market that was more depressed than it is today. It was a buying opportunity to get in at those prices, at those levels, because the banks were in extremis. They needed capital. Investors piled in. They've made money over the last year. We don't have that situation in Europe. What we have in Europe instead, I think, is still very much a shell game. You've got trillions of dollars in debt that's owed on a cross-border basis. In the case of Britain, France, and Germany, Spain, for example, owes, or Italy owes banks in those economies a total of $700 billion. Okay. Naturally, the Italian authorities wanted to make sure that they reaffirmed the fact that this was a robust exercise, because the feeling, I'm sure, is that these banks will need the capital top-up. Whether they get it is, I think, still up in the air.
Okay, folks, we just have to take a quick break. We'll continue this conversation about the EU bank stress test right after this. Please stay with us. From Vancouver, Alex Jershevsky, CEO of Recovery Partners, and from New York, Christian Freeland, Global Editor-at-Large at Thomson Reuters. Bob, I want to go back to you in Boston because we do now have a number. Go ahead, Alex.
Well, absolutely, because we're dealing in a world where we've got solvency problems and confidence problems in the banking system. The authorities are perfectly correct in wanting to stamp out this issue and make sure that market confidence is restored in these organizations. But at the end of the day, I think everybody knows that the elephant in the room is the fact that a lot of these banks have shaky loan portfolios, and they're going to need to recap their balance sheets.
Okay, let me ask you this, Alex. Alex, let me ask you this. Where are we on the risk of sovereign debt defaults right now? Has the risk passed? Is the risk still there? What?
Oh, we're still in the middle of this situation. We still don't know how big this problem is, and we're still in a situation where government deficits haven't been reined in, where governments are going to have to come up with increasing share of revenue to pay their interest bill as we move forward. The vulnerability of certain governments to an interest rate shock is extremely high. So we're sort of halfway into this sovereign debt crisis. We're not at the other side yet. There's still a lot of places at risk, large places. And if you look at just the amount of cross-border risk exist. I said in the case of Italy, Italy owes 1.4 trillion in cross-border debt. Half of that is with banks in Britain, France, and Germany. Spain owes a total of 1.1 trillion. Half of that risk is with banks in Britain, France, and Germany.
Let me add something about Spain.
Ireland at 900 billion.
Let me add something about Spain. We have from Santander, Banco Santander, Tier 1 capital would remain at 10%, the same as at the end of 2009. But also we're seeing that the Spanish tests include a 61% decline in land price. Krista, to you,
Well, there are two issues, right? I mean, there's the question of the Spanish banks, and then there's the question of the sovereign debt. And I think one of the complexities of the European situation is it's not, when we compare it with what was happening in the United States, people were very concerned about the solvency of the U.S. financial sector, but people were not worried that the U.S. government was going to default.
Okay. Sorry, I just want to go back to Bob in Massachusetts. Bob, you head up a huge investment management company. Investors who are watching want to know, what do you do if you hold shares in any of these major European banks? Do you buy more? Do you sell them? Do you short them? Do you hold them? What do you do?
Well, I think we're going to see that some of these major banks are going to announce in detail what their position is, probably the ones that do better. Bank Santander, for instance, now has probably as much in South America as it has in Europe. So it's in quite an unusual situation. But I think to investors, they have to wait and see. We're just starting to get the data. It will take probably another day or two before we can actually read all this. But I believe that you're going to have three categories of banks. We have the 7 that are going to need capital. You have those like Barclays that are going to pronounce that they really weren't that much into the loan business, and they're at 13%. And then you have the in-between group where they passed the test. Exactly how much they passed it depends on how the national regulators were doing. And those people are going to raise capital, and the market's going to tell you what the price is. And investors should wait and see what the market's going to tell them.
Well, 45 seconds left. Alex, you wanted to make a point? Sorry.
Well, I mean, there was no explicit modeling of sovereign default, so I think all the comments that have been made, I totally agree with. But again, the stress testing exercise did not explicitly consider the probability of sovereign default of Greece or Spain or another economy. And, that goes back to the fact that bank capital ratios, and banks were buying this sovereign debt because it had zero risk weighting. So they were able to leverage it up on their balance sheet and put it on with zero risk weighting. So there was a tremendous incentive for banks to acquire a lot of these sovereign claims, and that's the issue. I mean, how much sovereign debt do these banks own? Whose sovereign debt is that? And if you explicitly model a sovereign default of those debtors, what happens to that bank? We still don't know the answer to those questions.
Folks, we have to leave it there. Unfortunately, we're out of time. Great to have the three of you with me today. Many thanks, Alex Drashevsky of Recovery Partners in Vancouver, Bob Posen in Boston. He's with MFS Investment Management, and Christian Freeland of Thomson Reuters in New York. That's it for Headline. Any comments about the program, please send us an email at headline@bnn.ca.